Hey everyone, welcome back to the deep dive. When you've built up a sizable portfolio, a pretty common dilemma pops up.
Oh, absolutely.
You need a chunk of cash, right?
Yeah.
But selling assets, ugh, not ideal.
No.
Taxes, messing up your long-term strategy, not fun. So what's the alternative? Well, that's what we're diving into today.
Sounds intriguing.
Loans against shares. Ever heard of them?
I have, yeah.
Securities-based lines of credit, stock loans, they go by a few names.
Right.
We've been boring over this guide, Loans Against Shares 2025 Guide to Unlocking Liquidity.
Okay.
It's geared towards, well, you, our listeners, high net worth individuals, investors, C-suite folks,
Makes sense.
people who need to access capital efficiently. So, today's mission, figure out how these loans work, what benefits they offer, and of course, the risks. What do you say? Ready to unlock some liquidity?
Absolutely. Let's dive in.
All right, first things first, what exactly is a loan against shares?
Okay, so in essence, it's a line of credit. But instead of your credit score being the main factor, you're using your investments as collateral.
Interesting.
Stocks, bonds, ETFs, mutual funds. Think of it like a mortgage, but for your portfolio.
Ah, I see. So you're not selling your investments, just borrowing against their value.
Exactly. You retain ownership, which is a key advantage we'll get to.
Okay, got it. So how much can you actually borrow? Is there like a set amount?
That depends on something called the loan-to-value ratio, or LTV.
Mm-hmm.
It's basically a percentage of your security's market value that the lender is willing to loan.
So higher value, higher loan amount.
In general, yes.
Mm-hmm.
But it's not that simple. The LTV is influenced by a bunch of factors.
Like what?
Well, the lender's own risk tolerance, for one.
Mm-hmm.
Then the type of securities you're pledging matters, too.
Ah, makes sense. Blue chip stocks versus, say, a volatile penny stock.
Exactly. Liquid, stable assets will usually command a higher LTV. And then there's the overall market mood. If things are shaky, lenders get more cautious, lower LTVs.
So it's not a static number. It can fluctuate.
Oh, absolutely. As the market value of your pledged securities changes, so does your borrowing power. Something to keep in mind.
Gotcha. So we've got the basics down. Now let's talk benefits. The guide keeps mentioning liquidity without liquidation. What's the big deal about that?
Well, imagine this. You've spent years, decades even, building this amazing portfolio.
Right.
Suddenly, a golden opportunity appears. A business venture, a real estate deal, you name it. But you need cash, and fast.
And you don't want to sell your stocks, especially if they're performing well.
Exactly. That's where loans against shares shine. You get the liquidity you need without disrupting your investments. No selling, no triggering capital gains taxes.
So you maintain your investment strategy, keep those assets growing, and still seize the opportunity.
Precisely. And there's a psychological benefit, too. Not having to sell during a downturn can prevent emotional decisions.
Right, no panic selling. Smart. Okay, what else? The guide mentions competitive interest rates. How do those compare to, say, a personal loan?
Usually they're more favorable. Remember, your portfolio is the collateral. That lowers the lender's risk, so they can offer better rates.
Makes sense. Are these rates fixed or can they change?
They can be either fixed for a set term or variable, tied to benchmarks like SOFR,
This SOF.
Secured Overnight Financing Rate. It's a common reference point for short-term lending.
Gotcha. So rates can go up just like any other loan, depending on the market.
Yeah, if you choose a variable rate, that's a risk to consider. Of course, other loan types would likely see rates rise too in that environment.
True. What about actually getting the money? Is it a long, drawn-out process?
Not usually. Applications for these loans tend to be more streamlined than traditional ones.
And once approved?
Access is usually pretty quick. You've got this line of credit, so you can draw funds as needed and repay according to your agreement.
That's handy. Okay, this next one is interesting. Potential tax advantages. But the guide's quick to say, talk to a tax advisor.
Right, tax laws are complicated, tons of nuances, but here's the gist. Depending on how you use the loan proceeds, the interest you pay might be tax deductible.
Like for business investments?
Exactly, or certain investment activities, though there are rules around that. Always best to consult a professional to be sure.
Absolutely. Okay, last benefit listed is no prepayment penalties, typically.
Yeah, that's a big plus. If you have extra cash, you can pay down the loan early without getting hit with fees.
Nice. But the guide mentions this mainly applies to lines of credit, not fixed-term stock loans.
That's right. Those usually have a set repayment schedule. Early repayment might come with penalties, so it's important to know the details of our agreement.
All right, so we've covered the good stuff, but let's be realistic. There are risks, right?
Oh, absolutely. Leveraging your portfolio always comes with risks. We need to be upfront about that.
Okay, so the guide starts with market volatility. That sounds pretty self-explanatory.
It is, but it's the core risk here. The value of your collateral, those securities, can go down, sometimes a lot.
And if that happens,
You might get hit with something called a margin call. Basically, the lender wants more security because your collateral's value has dropped.
okay, let's break that down. What exactly does a margin call involve?
So let's say the market takes a dip and your portfolio's value falls below a certain level that was agreed upon with the lender. They'll contact you and you'll have to deposit more cash or securities to bring the LTV back in line.
And if you can't do that?
That's where things get tricky. The lender can and often will liquidate some or all of your pledged securities to cover the loan.
So you could be forced to sell at a loss, the exact opposite of what you want.
Exactly. And these margin calls can come quickly. Sometimes you'll only have a few hours or a day to respond. So having liquid assets on hand is crucial.
That sounds stressful.
It can be. That's why understanding market volatility and having a plan to address potential margin calls is so important.
Agreed. All right, interest rate risk, we touched on that earlier, but what's the main concern?
If you have a variable rate loan and those benchmark rates rise, your borrowing costs go up. Simple as that.
So higher monthly payments, overall cost of the loan increases.
Yep. It's all about your risk tolerance. Can you handle potential increases in your debt servicing costs?
Good point. Okay, the guide also mentions that these loans aren't for every investment. Why is that?
Lenders have their preferences. Some securities might not be eligible as collateral, or they might have much lower LTVs.
Like what?
Think illiquid assets, highly volatile stocks, things that make lenders nervous.
So you can't just assume your entire portfolio is good to go.
Nope, you need to check what the lender will accept and at what LTV.
Makes sense. Okay, complexity. What makes these loans more complex than, say, a simple personal loan?
There are more moving parts. Loan-to-value ratios, margin call triggers, the agreements themselves are often more intricate. It's not just about your credit score. You need to grasp the mechanics of using your investments as leverage.
Got it. And lastly, the big one, potential for loss.
Right. This is where things get real. Remember, market conditions can amplify losses. If your collateral's value plummets and you can't meet a margin call, the lender can sell your securities, potentially for less than your loan amount.
Ouch. So you could end up owing more than you borrowed.
It's possible. Now, there are non-recourse loans where the lender's claim is limited to the collateral itself, but those are more specialized.
We saw that in Sarah's example.
Right,
Yeah.
exactly. But the key takeaway is this. Using margin involves risk. You need to understand your risk tolerance and investment goals before even considering this.
Solid advice. Now, there's this distinction the guide makes between stock loans and margin loans. What's the difference? They seem pretty similar.
They both use your investments as collateral, that's true, but their purposes are distinct. Margin loans are primarily for buying more securities.
So more leverage, more potential gains, but also more potential losses.
Right. Stock loans, like the lines of credit we've been discussing, have a broader scope. They can be used for various financial needs, not just buying stocks.
Interesting. So it's all about the intended use of the funds.
Exactly. Plus, margin loans often face stricter regulations, limits on how much you can borrow, things like that. Stock loans tend to be more flexible.
Gotcha. And interest rates. Any major differences there?
Margin rates can be tiered, lower rates for larger loan amounts. Stock loans might offer more consistent variable rates or even fixed rates. Again, depends on the lender and the specific terms.
So multiple factors to consider. Speaking of real-world applications, the guide tells this story about Sarah, an entrepreneur.
Oh yes, Sarah. She needed $10 million to launch a new business, but most of her wealth was tied up in stock.
Classic dilemma. Did she sell?
Nope. She secured a non-recourse stock loan, using her shares as collateral.
Smart move. So she kept ownership of her stocks, avoided immediate capital gains taxes, and got the funds she needed.
Exactly. And she used profits from her new business to cover the loan interest. Plus, her stock value kept rising, improving her LTV ratio. It's a win-win.
A great example of how this can work strategically. Okay, so let's say someone's listening, thinking, hey, this might be for me. What should they keep in mind when choosing a lender and structuring the loan?
First and foremost, the lender's reputation and experience matter. Look for established institutions with a solid track record in securities-based lending.
So not just any bank on the corner.
Right. Private banks, reputable investment firms, those are your go-to options. Find a lender with a dedicated team that understands this specific niche.
Okay, what else?
Compare LTV ratios from different lenders. They won't all be the same, especially for different types of securities.
Got it. Shop around, get the best terms.
Exactly. And understand what factors influence those ratios. Liquidity, volatility, concentration of the asset in your portfolio. It all plays a role.
Makes sense. And of course, interest rates and fees.
Absolutely. Fixed or variable, any origination fees, annual charges, early repayment penalties, all those details need to be crystal clear.
And given the market volatility risk, margin call procedures are crucial, right?
Oh, absolutely. You need to know exactly how the lender will notify you, how much time you'll have to respond, and what happens if you can't meet the call. Don't be afraid to ask those tough questions.
And flexibility in the loan terms is always a good thing.
Absolutely. See if the lender is willing to customize the terms to suit your specific needs and goals.
And the golden rule.
Read the loan documents carefully, all of them. If anything's unclear, get legal advice. Don't sign anything you don't fully understand.
Solid advice. So wrapping up our deep dive, it seems loans against shares can be a powerful tool for savvy investors.
They can, yes. It's a way to access liquidity without selling your investments, maintain your strategy, and potentially benefit from competitive rates.
And it's a big but, the risks need to be taken seriously.
Absolutely. Market volatility, margin calls, the potential for loss, those are real factors to consider.
So to our listeners, do your homework. Choose a reputable lender, structure the loan carefully, and manage those risks.
Couldn't have said it better myself.
Yeah.
It's about leveraging your assets wisely, not recklessly.
Well said. Now, here's something to ponder. As you think about leveraging your portfolio, what other assets might you have that could be put to work?
That's a great question.
Maybe there are hidden opportunities waiting to be unlocked. Thanks for joining us on this deep dive.
It's been a pleasure.
Until next time, happy investing.